You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Welcome back to another edition of the Shoe In Show. I think we're like 300 and something episodes into this journey. When we started, I had no idea if we could get past the first week, but here we are. And Thomas Crockett, my fellow Shoe Insider today, we've covered a ton of issues on this podcast. We've talked about fashion trends. We've talked about, goodness gracious, supply chain challenges. We've talked about market weeks. We've talked about tariffs and trade and 3D printing, and we've toured the Keene facility in Portland, Oregon. We've done all types of things, but we have to, at some point, Thomas, talk about taxes, right? And there's two things in life that we all know. It's death and taxes. You can't avoid either of them, but you can kind of mitigate and try to find some savings. And so our two guests today are experts in guiding corporations through the federal tax code, and particularly footwear companies. They have experience in that. So Thomas, welcome. First, welcome to Shoe and Show with me. And secondly, who do we have on the program today?
Yeah, so we are very excited today. You mentioned taxes. So I think the key word there too is savings. So we're talking about tax savings today. We're dealing with a lot with, tariffs. We've dealt with the pandemic, with supply chain disruptions, inflation now. So we need any savings we can get. So we're very excited to bring in our guest today, Joel Boff and Arvi Kaur. They're with CohnReznick, which deals with tax issues and tax savings issues. So want to welcome both of you to the program today.
Thank you, Thomas.
Thank you.
So Joel, let's get right into it. Let's talk about tax savings. You deal a lot with pass-through entities and pass-through entity taxes. Can you just, for people that aren't familiar with that, can you just kind of give us a breakdown? What exactly is that? And let's just start. What exactly is that?
So, let me kick off by saying I never thought taxes and fashionable would be in the same podcast, but they are, which is kind of interesting. But you're right. We want to focus on savings. And oftentimes the area where you can have the most planning and get the biggest bang for your buck is with estate taxes, which is why my colleague Arvi is on. But generally speaking, most businesses, at least in our space, industry agnostic, operate as pass-through entities. A pass-through entity is probably what you know as a partnership. Can also be an S corporation. Can also be a sole proprietorship, which is something called a Schedule C on an individual's 1040, but that's probably not specific to what we're talking about today. Most businesses, especially in the fashion, apparel, retail, distribution space, operate as flow-throughs in the middle market. What that means is that the income or loss from that business flows up to somebody with a heartbeat on a Form K-1, and that individual picks up their share of the income or loss on their individual tax return and pays tax on that amount. The reason pass-through entity tax has come to light in the last few years is because back in 2017, you probably remember where a cap was put on the amount of state and local tax that any one of us is allowed to deduct on their 1040. I live in New Jersey. I have really high real estate taxes, really high income state taxes. I know folks on the left coast do as well. We're only allowed to deduct $10,000. So if I pick up $500,000 on a Form K-1 that flows through from my business, my state tax on that could be $60,000. I can only deduct $10,000 of that right now. The pass-through entity tax regime came into play by states trying to mitigate that difference, that $10,000 deduction, and say, hey, what if the entity, the pass-through entity, which normally doesn't pay tax, pays tax on behalf of the shareholder or the partner, and the entity deducts it? The entity is allowed to deduct all of their state tax. So what happens is, instead of me now having $500,000, I'll have $500,000 less my $50,000 of state tax paid. So my income that I'm now picking up on my federal return is only $450,000 instead of the 500, and I therefore have kind of gotten around that $10,000 cap.
Anything, you're talking about this, anything that companies need to be careful with this? Are there any like warnings when you're dealing with?
Well, there are rules. Arvi can get into some of the specifics, with regard to New York State, which we see a lot of, New Jersey as well. Initially when the pass-through entity tax came out, I think the first state, Arvi, may have been Connecticut, right? I think it was Connecticut. And then New Jersey did something called the BAIT, and now New York has something called the PTET, and I think there's 23 or 24 other states that allow this now, and it's on the rise. Everybody was worried that the government would shut it down, right? The IRS would say, hey, this isn't a valid tax deduction. You guys are just trying to skirt the $10,000 cap, and that's not right. Well, the IRS actually ruled that it's okay. It's allowable. So once they had that ruling, a lot of states hopped on the bandwagon and instituted their own PTET, pass-through entity tax regime, which accomplishes the same thing, but they all have different rules.
Well, it's a competitiveness issue. I remember at the time, Thomas and I were actually lobbying at the House at the time was considering the border adjustment tax regime, and we were freaking out over that, rightfully so, as importers. And then they avoided that, and they ultimately passed this. And I remember all the House reps who represented the New Jerseys and the Californias and the New Yorks of the world were highly concerned about how this would impact competitiveness. So to have the IRS rule in favor of these entities seems to make sense from a competitiveness standpoint. But Arvi, what are some of those rules that people need to be aware of? Kind of help us walk through the landscape. Are there any landmines, as Thomas indicated, or is it kind of smooth sailing once you figure out the rules?
Sure. So like Joel mentioned, these PTETs have been enacted in 20 plus states. We're almost at about half of the states, and the states that haven't enacted it, they hopefully will enact something like this to give individuals this particular benefit. But we're kind of monitoring that part. Most of the PTETs are elective, except for Connecticut. Connecticut has made it mandatory. Every other state is elective. So it really makes sense to look at whether or not an election is going to be beneficial for the owners in each particular state that they might be operating in. So some of the factors or questions that they should be considering are, first of all, what is the composition of the pass-through entity right now? A lot of times, if it's a more complex structure, the decision process becomes more complex as well. Like, for example, if you're only filing in one particular state, the decision process is a lot easier than if you're filing in, let's say, 15 or 20 different states, and you have 15 or 20 different members, and all of these members are residents of various states. So that's one of the key items to kind of look at when you're trying to make the decision of whether or not you should be making an election. And then in addition to that, the members themselves, as owners of these businesses, should really be thinking about a number of different things. One of the items that comes up is, will the election be binding on all of the owners? So if the entity makes the election, is that basically including all of the members, or is it including only some of the members? That's really important. Like, for example, California allows each member to either opt in or opt out of the PTET. Every other state pretty much basically, if the entity makes an election, every member is bound in if they are considered an eligible member. And then the other question that really comes up is the PTET credit refundable? This is important because let's say the PTET or the pass-through entity paid in $50,000, and when the individuals file, their tax due is really $45,000. What happens to that $5,000? Do these individuals get a refund for it? Or is it a carry forward, or is it absorbed by the state? That's important because obviously you don't want to lose out on the money that you're paying in. For example, California is the state that the credit is not refundable in. So individuals really need to think about whether or not they would make an election in California where the PTET credit is a carry forward. A state like New York, they refund it. So there, the decision might be a little bit easier. The other questions to really consider are, will each individual's resident state allow the PTE owners a credit for taxes paid to another state on their share of that PTE income? Right now, if you're, let's say, a resident of New York and you're paying taxes in a whole slew of different states, you'll generally get a resident credit for the taxes paid. The question that comes up is, if I made a PTET election in California, am I going to be allowed to take that as a credit on my New York return as a New York resident? Some states, this may be very straightforward. Some states, it's not. For example, Maine. Maine basically has a court case out there that says you cannot take this as a credit. So if you're a Maine resident individual, you really have to look at a lot of other factors to see whether or not this type of election is really beneficial for you and your business. And then, there are some other more smaller questions like, will the individual still need to file a personal income tax return? What if they're filing a composite tax return? Can they file a composite and take a credit for the PTET taxes that are due? And then aside from that, there's cash flow issues. Some of the states, they require payments for non-resident withholding and estimated payments for the PTET. So, for example, New Jersey is requiring this, and you're having a double payment that is going out, and the individuals have to really be prepared, as well as the business, for this cash flow issue that might exist. It's more of a timing difference because the money does get generally refunded to the individual, but it's just another consideration for each of those individuals from a cash flow standpoint. And then the last thing I'll mention is estimated payments at the individual level. Will the PTET cover the individual's estimated payments at the individual level, or does the individual have to pay in taxes? Again, my home state is New York, so I'll just use New York as an example.
Right.
In New York, let's say I pay in the PTET only covers the New York State portion. It doesn't cover New York City. What if I'm a New York City resident as well? So that's an amount that I will have to consider to be paying in as an individual as an estimated payment. Although New York City has also enacted a PTET for 1/1/2023. So again, those are some of the nuances that you're really going to see on the PTET side. And I know I've said a lot, but just these are the things that you should be considering. And when you're trying to decide the impact of making these elections, just consult with your tax advisors, have a sit down, and just have that conversation. It'll really be beneficial.
Joel, it sounds like there's a lot you need to consider with this. Let me bring you in here too. Can you talk about, so it seems like there's a balance here. There's a huge savings potentially, and especially because we have a lot of members in high tax states. Their companies are based in places like New York. But there's also, it sounds like, a really complex system with this, and you need a lot of guidance. Are you seeing trends where this is, really being utilized, or is it underutilized because of the complexity? Kind of what are you seeing from companies here?
So it's a great question. Seeing a little bit of both. It's all of the rules that Arvi just described have to be applied to the 23 or 24 or 25 states that now have it. Some states it might not make sense because the apportionment or the amount of business income generated from that state is low enough where it really doesn't make a difference. It usually just makes sense if there's a high apportionment. A lot of clients that we see are going through the exercise initially to determine whether or not it makes sense, right? So you'd say right off the bat, hey, this is a no-brainer. It absolutely makes sense. Well, it might not make sense for a couple of reasons. There's clearly an increased amount of administrative burden and therefore increased amount of fees having to do with these filings. And it could also pose a huge burden when you try to figure out, I could have a partnership with 5 partners that all live in the same state where it's really easy. I can also have a partnership where I might have 45 partners and 35 of them could be individuals that live throughout the country. I could have some foreign partners. I could have some estates or trusts. Those types of instances require a ton more calculations to try to figure out what the benefit is. Because candidly, you could have a situation where it really only benefits a handful of partners, and the rest don't have any benefit or very little benefit at all, other than the reduced amount on their federal income tax. So what happens there is, you got to take a look at the partnership agreement and say, hey, is there, for lack of a better word, a true-up clause or any type of specific allocation allowed in the partnership agreement to help compensate somebody who's not getting the benefit of this deduction for somebody who is. So you get into, is one partner subsidizing the benefit of another partner because that partner, let's say, may live in may live in Florida or Texas and don't pay individual income tax.
So this begs the question, and I think that, well, one, I'll start with you, Joel, and then I'll pivot to Arvi. I've got a question for you, Arvi. But before we get there, how does CohnReznick, if as people are listening to this and they're like, oh my goodness, how do I even take advantage of this? Where do I go? Tell us where to go, right? Where is this all, other than Arvi's brain, which seems to have all the rules memorized? Where else can we go to figure out how to navigate all this?
Well, part of the client service team is Arvi's brain, and there are other brains within state and local as well. So we, just so happens we do work a lot with Arvi, and we love it. So what happens is typically your client service team will start to have these discussions with you. It's not that you need to go to CohnReznick for this, unless you're not a client, and then we would love you to come to CohnReznick. But your client service team is reaching out to you on a regular basis to discuss this, because if I have a partnership that operates mostly in New York, maybe in California, and maybe in another state, we have to have conversations on a regular basis to determine whether or not this makes sense. Because at the end of the day, usually these PTET elections need to be signed by a partnership representative, or all members of a partnership or an S corporation. And it's kind of like you're damned if you do and you're damned if you don't, right? Because if you make the election and a couple people benefit greatly and someone doesn't, the someone who doesn't is going to probably blame whoever decided to make the election, for hindering them. So at the end of the day, what's going to happen is your client service team is going to come together and have regular planning meetings with the partnership to see how the rules fit, because calculations need to be done, like Arvi mentioned, on a quarterly basis. So it's an interactive, iterative process where, you have to determine on a regular basis, does it make sense to do it? And most of the pass-through entity tax elections, Arvi, correct me if I'm wrong, are made on an annual basis, right? So you can do it one year when you have income, and you don't do it in another year where you have a loss and it wouldn't necessarily, make sense to do it.
Got it. Well, let's pivot real quick, Arvi. Let's tap into your brain one more time. Let's talk about online sales. So our companies increasingly rely on e-commerce. And we track the numbers weekly, and we can see this growing trend throughout retail, not just for footwear, but for all consumer goods on e-commerce. And so there's 50 different entities as it relates to e-commerce sales. And talk to me about online sales and nexus in states. What generates nexus studies? What is a nexus study? And how do companies make sure they're withholding and remitting in a timely fashion?
Sure. So maybe I'll just start with what is nexus? So historically, sales tax nexus, or what we like to say minimum connection that requires a company to file within the state, has been generated through physical presence. That was historically, whether that was property in the state, whether that's fixed assets or inventory, employees working in the state, offices within the state, or other types of physical presence. In June 2018, the Supreme Court decision in Wayfair versus South Dakota really changed the landscape of nexus. This decision basically said that nexus is established when you exceed sales of $100,000 to the state, or when the transaction count exceeds 200 transactions. And this is even if you have no physical presence within the state. Basically, once the Supreme Court decision was passed, every single state at this point has some sort of version of that rule, which I like to call the 100 or 200 rule, basically. And if your company is selling retail or even wholesale, this can have a huge impact on the company itself. So I think I'll go over the impact of this particular decision on distributors first. So the impact of this decision that distributors should be aware of is that although there may not be any retail sales, a registration and filing obligation may still exist in some of these states. Most states' rules look at gross sales, not just retail sales, when they're determining whether the thresholds have been exceeded. So that's really a key point. In addition, there are about half the states that require distributors or wholesalers to register and or file sales tax returns, even if the taxes due are zero. So these states are also the same states that generally require a registration in order to issue and or accept a resale certificate. So even though there are no taxable sales, there could be an impact on wholesalers as well. And then you have companies that are making both retail sales and wholesale sales. We have a lot of clients that they were originally selling wholesale, and then the whole online phenomena occurred, and they decided to start selling a lot of their products online, basically, to end consumers. And this area can get a little bit tricky. If the primary business revenue is from wholesale sales, the thresholds may be exceeded fairly quickly, and that may end up requiring a filing obligation and tax remittance obligation on retail sales, since the thresholds include all sales, not just the retail sales. So like, for example, if I'm selling into, let's say, a state like South Dakota, and my wholesale sales to South Dakota are $90,000 and my retail sales are only $15,000, that brings me over the threshold, and I have to file, register, collect tax on that $15,000 and remit. Then you have retailers that are strictly retailers or online sellers. And for them, it's fairly straightforward. If the threshold is exceeded, then a filing remittance obligation exists, and you should generally be collecting sales tax and remitting that sales tax. Of course, when you're looking at the rules and all of these different type of situations or different type of revenue streams that you're getting, even if an entity is below the threshold, physical presence standards still exist. So you still have to look at that as well. So when we are doing a nexus study, these are basically the areas that we look at. Sorry for the background noise. So these are the areas that we generally look at when we're looking at when we're preparing a nexus study. It's usually, where is your operations, physical presence, and what are your sales and transaction thresholds looking like, to see whether or not you have a filing obligation within that state.
So I do have a question. If you've got, all right, you have these smaller retailers that, are doing online sales throughout the U.S. There's a lot to manage here. Are there some good resources or places they should look to try to get a better hold of the whole nexus concept?
Sure. So a lot of, obviously this is a huge burden on a lot of small business owners. They really have to look at the administrative cost of compliance, and they also have to look at implementing software programs that can help calculate the sales tax in all of these various states. Some of those software programs, just going down the list, they might already be aware of them, are TaxJar, Avalara, OneSource, Vertex. These are all programs that generally get integrated into their websites, and they calculate the sales tax for them based on zip code if that particular state is a quote unquote turned on state for sales tax purposes. And then in addition to that, they can also there's a lot of literature on the MTC, or the Multi-State Tax Commission website, that provides good guidance on sales tax issues related to basically the Wayfair rules and the filing obligations there. And then, of course, your tax advisors. You can always reach out to your tax advisors and get guidance from them, and they can help. Like, for example, myself at CohnReznick, sometimes we just have a conversation with a lot of our clients and give them the layout of the land of what's been going on with Wayfair, what we would recommend to them, what the risks are of compliance and non-compliance related to sales tax for those particular companies, and then kind of just taking it through that process with each of your clients.
That makes a lot of sense. So, Joel, I've got one last question for you, and then a real quick one for you both as we close out. Joel, what's the best way for folks who listen to this and are now like, oh my goodness, I got a lot I need to figure out? What's the best way for them to reach out to you guys?
Best way to reach out is Arvi and my bio. We're right on our website, www.CohnReznick.com. I'm assuming we can somehow, maybe as part of this podcast, if there are folks that listen in and want to, and somehow provide a communication means, we can certainly give you phone numbers and email addresses. But yeah, the best way to get in initial contact is right on our website. You can find both of our bios there, as well as other services we provide from both federal, state, and local, industry related and whatnot.
Got it. So it's Joel Boff and Arvinder Kaur, or Arvi. You can find them there on the CohnReznick site. Thomas, you got something?
Yeah, and it's CohnReznick, RezNick, if you need to spell it.
.com, www in the front. So last question, Arvi, what shoes are you wearing?
I am currently in my comfy flip-flops that are house slippers.
There you go. There's no shame in that. See, you're always, Shoe and Show, everyone's always safe no matter what the answer to the question is. Unless it's shoeless, then we might have a problem. Joel, what are you rocking?
I'm embarrassed to say, but they're comfortable. They're a pair of navy blue Sperry boat shoes that have holes all over them from both outside yard work as well as my dog chewing on them, and I wouldn't give them up for the world.
Man, that's real life. That's all that is, Joel. There's no shame in real life, man.
None.
That's awesome. Well, I can't thank you enough, Joel and Arvi, for coming on. I think I can speak for Thomas when I say we are now smarter for having this conversation with you. And so thanks for coming on Shoe and Show. We really appreciate it.
Thank you both.
Folks, this has been another riveting edition of the Shoe and Show. We ask that you go in and rate us at all the opportunities you have to rate this program. The interesting thing about our rating system is that we've developed an AI program that kicks out all ratings except for 5 stars. So you have to rate us for 5 stars. That's just how it works. It helps spread the word and get more and more listeners digging in weekly to hear more about what's happening within our industry. Go to shoeandshow.com. You can access our entire catalog of episodes throughout the years. And then there's actually an icon there on the website where you can drop us a voice note as well. Click on the mic image, drop us a voice note for a message you have for us or a recommended guest, and we'll be happy to play that on the air. In the meantime, on behalf of my co-host, Thomas Crockett, thanks for joining us, and Shoe and Show is out.
Shoe In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.